Hello and welcome to the EklipX podcast, The Commodity Playbook. This is a channel for the entire commodity trading industry, including the next generation looking to break into the space. From the trading floor to entrepreneurs, we interview market experts and traders to better understand and navigate the latest industry trends. Our mandate is clear. We aim to provide greater transparency and better access in an opaque and cyclical market. In this second episode, which will focus on the gas market, we are joined by a well-respected researcher in the energy trading market, Seb Kennedy, the founding editor of Energy Flux. Welcome to the show, Seb.
Thanks, Max. Great to be here.
Now, for those of you that don't know, Energy Flux is an independent newsletter all about the role of gas in the energy transition. Seb has written about energy markets since 2008 for a variety of industry publications and energy consultancies, including more recently EklipX Research. So, firstly, Seb, how is the gas year shaping up and how are traders positioned for the winter?
The European gas market is teed up very delicately for the coming winter months. We've seen just last week the first mini Dunkelflaute of the season. That's the first kind of dark, gloomy, extended period of low wind and very low solar irradiation. So low renewables, we saw a big uptick in gas demand in the power sector, and also there's forecasts of lower temperatures. So traders are pricing in the anticipated higher gas demand from the heating sector as well. So last week was quite an interesting demonstration of the flexibility that gas still offers to the European energy system. And how central it's going to be for many years moving forwards. We saw the forward price on TTF, the main EU gas trading hub, just spiking back up to about 44 euros per megawatt hour this morning, on the back of those kind of quite bullish factors that are propelling buying activity in TTF Futures. And I think that throughout winter, we're going to see moments where, the market tightens a bit and, the prices immediately respond to reflect those kind of tightening factors.
You've been bearish on the TTF market for a long time. Can you explain why?
Yeah, absolutely. So essentially, European wholesale prices and by extension, European gas consumers, they've been paying a premium for gas, bought and sold on the TTF trading hub as a result of bullish factors that have been factored into the pricing that have not necessarily manifest. And what I mean by that are predominantly geopolitical factors. So we saw over the summer quite a strong bull run in the price of TTF. It dipped to 20-something euros in February, and then it rallied all the way up to 40-ish by sort of August, September. And we saw the biggest spikes occurring when there was heightened speculation around potential constraints to supply from geopolitical factors, both in the Middle East and in Ukraine, Russia. So, the price was reflecting risk that never manifest. And we've been paying that price for months now. And really the only factor that's sustaining, well, not the only factor, I'd say the main factor that's sustaining bullish momentum is geopolitics. And we haven't seen a cessation of Russian pipeline flows through Ukraine. We haven't seen any constraints to Qatar's ability to export LNG through the Strait of Hormuz. And yet, to an extent, the price already reflects the potential reality of that occurring. So my argument for some time in Energy Flux, and as I've been publishing on EklipX Research, is that any change to that baseline, the baseline assumption, the market is assuming that Russian pipeline gas volumes will be lost, on the 1st of January 2025 through Ukraine or before, and that there could be some sort of potential for disruption in the Middle East flows of LNG. And that just simply hasn't happened. So if that doesn't happen, if the LNG continues to flow out of the Middle East uninterrupted, and if gas continues to flow through Ukraine, which both are eminently possible, then your departure from the baseline is therefore bearish. So I see there being this kind of unjustified, slightly frothy risk premium that's being built into the forward price on gas and throughout the forward curve.
And is that why we've seen today the price of TTF Futures reach 44 euros? And I mean, is your outlook still bearish given the bullishness we're seeing right now?
So like I said at the start, the reason we've seen it come up to about 44 euros today is because of this kind of forecast of lower temperatures, and weather will always be the single biggest demand driver fundamentally, because heating is so dominated by gas. So that's why we're seeing TTF trading higher now, and like fundamental factors definitely still matter. And we're going to see, like I said, we're going to see periods where the weather gets colder, and that boosts the price up by a couple of euros. What I would say is that there's such a strong kind of speculative component trading in TTF futures that there will be these little sparks. It might be a geopolitical spark, it might be a kind of weather-driven demand spark, or maybe there'll be an outage on an LNG export project plant in the Gulf Coast. These little events, they get kind of blown out of proportion by the kind of excessive speculative trading activity that we're seeing on TTF. And so you get the spark, which is the event, but then there's like a whole load of gasoline poured on top of it because traders go absolutely crazy trying to kind of bid up the price of TTF beyond a price that would kind of reflect the rational amount of risk that's actually present in the market.
Do you think the TTF market will reach levels seen pre the war in Ukraine?
Possibly, but not 2025. And I would venture to say, there's a low risk of that happening in 2026. When we'll see like structurally lower prices will be 2027, 2028, because we're going to see a very big uptick in the amount of LNG supply entering the market. There have been a few kind of slight delays to these new projects that are coming on stream, and that news has kind of also been deemed to be a little bit bullish. But if anything, I'd say it's kind of the other way around. You're essentially going from a kind of extremely bearish baseline to a kind of very, very slightly less bearish baseline, because we're going to see a 25% increase in the liquefaction capacity available to the market in the space of about 24 months. And the last time we saw that was in 2015. We saw about a 35% increase between 2015 and 2017 in the first wave of US LNG expansion. When the US began exporting LNG for the first time, then the ramp up was quite quick, and the change relative to the existing amount of capacity was substantial. And what did we see in 2018? We saw netbacks between the US Gulf Coast and Europe going like zero negative. So that this was like pre-COVID, pre-Ukraine. Europe was the market of last resort for gas. So US LNG was arbitraging over to Asia because you get much better netbacks over there. And so like you see these kind of negative netbacks occurring. I would anticipate when we see this second big wave of LNG supply entering the market from the US over the next 2 years, in combination with capacity expansions in Qatar, we'll see a similar phenomenon, because demand is structurally lower in Europe than it has been over like the years leading up to the invasion of Ukraine. Russia's invasion has kind of just knocked so much industrial capacity out of the European economy. Plus, we've seen just this mammoth increase in the amount of renewables generation, just completely killing gas demand in Europe. And against that backdrop, you've got this 25% increase. Like I've said, that's only over 2 years, mind. Then we see even more additions between 2028 and 2030. So you're just going to see the equilibrium of the market shift significantly towards a position of oversupply, and it's just inevitable that sooner or later that will become reflected in structurally lower prices, both in Europe and in Asian LNG spot prices.
I have to ask you, after the news last week across the pond, Trump's victory, how will that impact LNG, natural gas and TTF markets, both in the short and long term?
Yeah, so short term, didn't see too much impact. You did see kind of across the board commodities softening slightly and stocks rallying quite significantly. That's a simple reflection of the market view that Trump is going to remove regulatory burdens to oil and gas supply. And being the world's biggest LNG and gas producer, then obviously that's bearish for both commodities because there's going to be more supply in global markets. I don't think it's going to manifest particularly soon, those changes. But what it does do, which I think is really important in how people understand the market over the medium long term, is that Trump's obviously going to remove the pause on US LNG export approvals, which the Biden administration introduced. When that happens, what it means is that projects that were kind of held in limbo by the pause, they will then be free to continue developing and try to reach a final investment decision and then start construction and meet their in-service dates, which were all kind of congregating around the sort of 2029, 2030, 2031 window. So like end of decade, start of the next decade. That's when these additional projects will potentially be entering the market at the tail end of a glut that's already baked in. So we're going into this structural glut of oversupply in LNG. What's happening is that the tailing off would potentially have tailed off around about 2030, could be pushed out even further. So the glut won't be deeper, but I think the glut will be longer.
What about the commitment of traders' position? How are funds trading the market? What's their net position in the latest COT report?
Yeah, so the Commitment of Traders report comes out with around about a week's delay. So the most recent data we have goes up to the end of the week before last. And we saw the hedge funds, they've pared back net positions from like kind of record length. So hedge funds had this immensely long position of like 266 terawatt hours in August. It's been a bit bumpy since then. We've seen them taking out new short positions. We've seen some length be sold off. So currently they've got about 223 terawatt hours. So still like an immensely bullish position from hedge funds. They are overwhelmingly bullish on EU gas futures. They've kind of hedged their bets a little bit, so to speak, since the summer peak, which was when there was heightened speculation around like early loss of Russian gas flows through Ukraine. But they are still kind of expecting the market to remain tight and to be able to kind of manage risk in a kind of anticipatory way that kind of captures any potential upside from things like these Dunkelflaute conditions that tighten the market. They're very kind of profitable occurrences for the hedge funds. The physical players, so the gas suppliers, the gas producers, they are net short. They've been net short for 13 of the last 14 weeks of the COT report. And it is quite unusual for gas producers to be shorting the market like this, but they do tend to mirror the hedge fund positioning. The reason they do that is because you'll see them trading kind of counter-cyclically. So they'll buy the dip and they'll sell into the rally. So when you see them going net short, it's because they also expect there to be, they also see the price as being quite bullish. So what they do is they go short on their portfolios to lock in future sales and protect the value of their portfolios against a future correction. So, again, it's like we have aligned incentives here. The physical players and the financial traders are kind of playing both sides of the long short bet to essentially maximize their returns, and certainly for the physical players, it's I think it's kind of a precautionary positioning, but it's also quite opportunistic as well, because if like weather conditions suddenly do become much milder and there are no outages and LNG projects kind of enter the system, and there's generally kind of quite a loose market over the winter, having shorted at the height of the market, they've locked in those sales for future months. So they've protected against like a kind of a downward correction that would come later in the season.
Why is the current position of funds impacting European gas storage? And what are the consequences of that position?
Yeah, so the storage angle is fascinating in the European gas market. So the last two winters, we've emerged because the European Union introduced a refilling mandate where they first of all had to reach 80%, I think, full by the 1st of November. That was increased to 90%. But because of like very judicious and proactive procurement by the strategic storage operators, they've achieved that target well in advance of the target date. What that means is that you're seeing very high storage levels being maintained for longer periods, and then Europe actually exiting the winter season with arguably too much gas in storage, this kind of big storage overhang, which then creates a lot of problems because you've got to then space out your procurement to reach the targets in such a way that you don't reach tank tops, so technically full storage levels too early in the following summer. So there is this kind of awkward sort of mandate, if you like. The refilling mandate creates this kind of artificially bullish sentiment over the summer, which then leaves the winter months kind of excessively supplied with gas held in storage, and then there being a big storage hang in the refilling season. So it's one of the problems about having a kind of an inflexible mandate on the refilling is that it does kind of allow the hedge funds almost to hold the storage operators to ransom, because they know they have to refill to a certain level by a certain date. So they can, take out long positions in summer months, which, then become, they can't really, it's kind of a bet you can't lose, because somebody has to buy that gas. They can liquidate those positions and obviously make great margins on it. We saw recently the summer month contract for TTF trading above the winter month contract. And I've been arguing for some time in Energy Flux that it's kind of like summer is the new winter. Because of this trading dynamic with the storage mandate, then you're seeing summer pricing above winter pricing at times, and procurement activity focused on the summer months. So there's been this kind of inversion in seasonality, and you can see that in like the forward curve. So everything's kind of there's a lot of price action focused on the front month. You've got like flat winter spreads, and then some kind of elevated trading activity over the summer, creating this kind of inverse winter-summer spread.
What do you think the price entry point is then for traders at the moment?
I absolutely would not want to guess that. That is, if I knew that, then I wouldn't be here telling you. I would be on a Bloomberg terminal making lots of money. I honestly, I don't know. There've been people talking about, TTF going easily as low as like 30 euros by January. And then, I would, depending on what happens with like Russia-Ukraine gas flows, I'm kind of starting to see the consensus view that actually there's going to be a continuation. By hook or by crook, you're going to have some sort of mechanism that allows Russia to retain some sort of market share in like the gas mix in Europe. So, I think, you could see towards like the lower 30s in the start of the new year. And then you'll see like the same kind of bullish momentum building up over the summer as people try to reach the 90% refilling target by 1st of November.
I want to delve a little bit more forensically into the TTF market. What specific factors are contributing to the systematic selling pressure by commodity trading advisors in the TTF market?
Yeah, well, if by CTAs you mean the hedge funds, then we've seen a couple of instances where I would say the mask has really slipped on how they view the market. And those were the two mini flash crashes that we saw in September and October. On both occasions, it was like the second occasion was like a deja vu of the first, because there was a lot of speculation and actually like a fake news report about, Russia and Azerbaijan doing a deal to allow continued Russian gas pipeline flows through Ukraine after the 1st of January, when the interconnector agreement expires between Ukraine and Russia. And the price action was very deep, very steep, very quick, very pronounced. And that really tells you that the bullish momentum, and everybody knows this, that the bullish pricing is extremely fragile, and there's heightened sensitivity over the possibility that consensus view of an end to Russian gas exports being changed. So So we saw TTF dip by between 5 and 10% in September. The same thing happened again in October. There was like another kind of fake news report that the kind of algorithmic trading operators bought into, and we saw this big correction in TTF, and then it kind of stabilized back up, had some losses. So in terms of like the selling pressure, it's very much a fear that the geopolitical factors just fail to materialize. And I think you're going to see that until the 1st of January when we actually get a clear view. If not before then, like an actual agreement being struck and being published and being confirmed, and then the market kind of readjusting around the new reality, which will probably be some sort of interim solution that allows gas to keep flowing through Ukraine.
What market scenarios could trigger a cascading unwinding of the positions of funds at the moment?
So the same event which I mentioned before, which is the Russia-Ukraine gas flows, and how we've already seen this kind of extreme market sensitivity to news flows regarding the potential for a continuation of those gas flows. I think we're going to see more speculation in both directions as we edge closer to a deal actually being done. So I would anticipate kind of extremely heightened speculation, excessive moves in both directions, and then probably the way these deals are done is that they get trailed. There's so much interest in knowing before the market really knows that you're going to see a lot of trading based on kind of low or false information, more of the same. But then as the deal actually kind of gets closer to being crystallized, then that information does tend to leak out through back channels. So I think you'll see the new reality being priced in gradually. So it'll be a question of like, can you see through the noise of the speculation in both directions to see which direction is the market actually moving in? Because that might give you some indication of what's actually being agreed. And then I think before the deal is announced, like just before, you'll probably see another big downward price correction. And then you'll probably see the market reestablish at like some lower baseline, which prices in the reality that yes, Russian gas is here to stay in Europe until it gets displaced by something else, maybe like US LNG, as the European Commission's been talking about. They're saying, yeah, maybe we could actually get rid of Russian gas altogether and like do some sort of deal with US LNG, soak up all the excess LNG in the market, do a big favor to Trump, try to rebalance that trade deficit with Trump, and kind of massage the new administration, make them feel they got an early win from Europe, plus a big geopolitical win against Russia. Trade is going to be a massive topic in the next presidency. Trump has pretty much intimated or explicitly said he's going to launch a trade war with his trade partners. Obviously, the main target for that will be China. But Europe is also going to get caught up in that. And it's very difficult for Europe to address the trade deficit with the US. And one of the few areas where it could buy more and also benefit geopolitically is by buying more US LNG. That would be a big help for the US LNG producers, not least because the last time that that Trump was in power and he introduced this trade war with China, then China slapped tariffs on US LNG, and China's imports of American LNG slumped to zero for a few months during the Trump presidency. So if he could kind of counteract that with a proper structured long-term framework agreement around US LNG or energy trade more broadly with Europe, then he could that could be the mechanism by which Europe saves transatlantic relations during a Trump presidency, and it kind of backstops US foreign policy relations and friction that's going to come in its showdown with China. And I guess this could, if this manifests, then it could really bake in the kind of basinization of LNG trade, and that's where LNG is traded within the basin of origin, not taking these longer arbitrage routes across to Asia. And that's good for emissions, that's good for efficiency, that's good for cost, because obviously the shorter trip from the Gulf Coast to like Gate Terminal or Grain or wherever in Northwest Europe, it's a shorter round trip. And if it helps to get Europe out of a geopolitical hole and to kind of meet energy demand without excessively burdening consumers, while also kind of keeping relations on a level with the Trump presidency, then I think it's a possible win-win.
With commercial hedgers increasing their short position while discretionary funds maintain their long position, what market conditions would be required to break this regime, and which group of traders is likely to capitulate first?
Yeah, so I would question the premise of that question, because it paints a picture of kind of a cat and mouse trading dynamic between the physical players and the hedge funds. And the more I've thought about this and talked to analysts and talked to different market participants, the more I'm getting a sense that actually the incentives are aligned. I mentioned earlier how you have the hedge funds and the physical gas players kind of playing both sides of the long short bet, and both making a lot of money or creating value and managing risk in a really cost-effective way by mirroring each other's movements. And we see that in the Commitment to Traders report. We can see that in the net long short positioning. There is a kind of inverse correlation between the two. And I don't know, like, I mean, there will be bag holders, there's always bag holders, right? But I don't think you can uniformly assign loss or capitulation to one side. It's more like who's the smartest on both sides, and they can actually both win. You're going to have like physical gas suppliers who are going to do very well out of like a well-hedged adjustment to a correction, in the same way that you'll see hedge funds kind of reading the market really effectively, and you know, getting like achieving their target off ramps at exactly the right moments before a correction occurs, liquidating those long positions, and then, you know, instantly buying in at the dip and probably even making money on the way back up again. And then within both of those groups, you'll get guys you get caught out. You know, you're going to see people get caught out. You're going to see gas suppliers who kind of have to, you know, get caught short, or maybe they've got like excess length and they just didn't quite time their exit strategy, and so they'll be reflected in their P&L. And the same with the hedge funds too. So I think you're going to see winners and losers on both sides, but I do think that they are essentially I wouldn't say it's like coordinated cartel-like behavior, but there is an alignment of incentives between the physicals and the financials. And they have been kind of working this highly liberalized trading hub to essentially work prices a little bit above where they probably ought to be at the expense of consumers. And then you see them repatriate these profits. In terms of the hedge funds, they repatriate their profits back to their clients in Asia, in the United States. And you know, if you're a physical gas player, then, you know, if you can see the way the hedge funds are positioning, and maybe you can time your maintenance accordingly, you know, maybe you can withhold volumes just kind of in a speculatory manner. I mean, I don't have any evidence of this, and whenever I mention it, then people tend to get a little bit of resistance. They're kind of like, "Oh, that's not how the market works." But it's a phenomenally easy money-making opportunity if you can read the markets and you have control of a big gas portfolio, or maybe you even have a proprietary trading arm that's not doing just like risk management work, but is actually, you know, like trading on the back of market signals, but backed up by a big physical position in the market. Then you can't really lose. So I think you've got to be kind of mindful of that reality.
That's a very interesting and somewhat controversial point. I want to move on now to gas freight rates, which I know you've written on extensively. They plummeted recently. Can you explain the collapse of gas freight rates?
Sure. Yeah. So, you know, the stock response is that there were too many ships, and that's absolutely true. We've seen a big influx of new vessels entering the market. There was a big kind of vessel commissioning period after the invasion of Ukraine, when, you know, the market was like, okay, we're going to need a lot more LNG because Russian gas has been lost to Europe, so we're going to need more ships. Turns out it's a lot easier and quicker to build an LNG vessel than it is to build an LNG liquefaction plant. So the ships came on before the projects, and we have seen some delays to new LNG projects coming online, while the ships haven't been delayed because, you know, there are very few impediments to building a ship, and it's great job creation in Asia or wherever the ships are built. So they tend to, they just tend to go ahead. So we've seen all this new tonnage entering the market, and there actually isn't necessarily the amount of volume of the actual commodity for them to handle. So as a result of that, you see freight rates going down because demand per ton is lower than it was before, and you're seeing that reflected in freight rates. But there's another factor, because that's where the conversation tends to end over the whole freight rates thing. It's like, oh yeah, too many ships. When the LNG comes on stream, it's going to catch up and you'll see freight rates recover. My argument, which is, again, probably a little bit controversial, is that actually it tells you more than that, and that like really low freight rates are a bit of a canary in the coal mine for LNG demand. Because if you look at the vital signs of freight utilization, then they're all very bizarrely low. And I'm not talking about just the fact that there's more ships than are needed. It's like measures of like fundamental vital signs of demand, both for the vessels and the commodity, are low. So ton days per month and ton miles per month, they're both absolute measures of overall demand for tonnage. They are not a function of the amount of tonnage available in the market. And I think that speaks to an underlying problem in the LNG space, which is that LNG is pricing off Europe. Europe is excessively volatile, bullish, and speculative. That increases the price of the delivered price of LNG in price-sensitive markets, and you're seeing reduced demand in the spot market as a result in price-sensitive markets like India, like Pakistan, Bangladesh, Southeast Asia. So the freight rate thing is a function of like too many ships, but also quite soft demand in these markets that the LNG industry is kind of clinging on to as the big saviors of gas demand for the rest of this decade and going into the 2030s.
You touched on it there. I just want to delve into a little bit more. How is the collapse influencing the arbitrage opportunities between major gas markets like TTF and JKM?
Yeah, so it's been a massive boon for the LNG industry, not for the LNG freight owners, because obviously they're all losing lots of money or getting much lower returns than they anticipated on their investments in these vessels, which are not inconsiderable investments, I have to say. And so when you've got like freight rates at like kind of $10,000 a day, which is like 10% of where they were just going back a few months, then that's going to hurt those guys. But for the commodity itself and the traders of the commodity, then obviously that's just a lower cost. So the lower freight rates were an absolute savior for the LNG industry. Why? This year we saw outages simultaneously on the Panama Canal and the Suez Canal. Drought in Panama, geopolitical problems in the Red Sea. You couldn't transit either, or it was very difficult to transit either of those strategic trade choke points. If freight rates had been at like $100,000 a day, then you would have seen gas prices going a lot higher, because essentially freight rate is just a cost of trade, and that is ultimately borne by consumers. So if you'd had a delivered price of LNG reflecting $100,000 a day, and you've got to do an 82-day round trip from the US Gulf Coast round the Cape of Good Hope all the way over to Tokyo or Beijing and back again, then you would have seen, I would say structurally higher LNG prices than we otherwise have seen. And it's really quite incredible that these two things happened at the same time. You saw, much longer journeys to reach Asia from the US Gulf Coast, and also for Qatar to reach Europe going around the Cape of Good Hope. And yet, the freight rates remained extremely low, and that essentially saved the market from, I'd say significantly higher, less affordable gas in all LNG importing regions.
What are the projections for fleet growth in the LNG carrier market over the next few years? And how might a continued increase in tonnage that you mentioned affect global LNG shipping dynamics and freight rates?
My shipping sources tell me that the additions to LNG tonnage have not peaked. We saw an uptick, I think this year, I think it was a 4-year high in the amount of tonnage that entered the vessel market. And that's going to be even higher next year, and it's going to peak in 2026. One analyst told me that we could potentially see negative freight rates next year, which is pretty mind-blowing. It's only happened once before. But with all this extra tonnage entering the market and LNG demand actually not being quite as strong as the industry wants us all to believe, for the reasons I've explained about like excessive speculation and price-sensitive consumers just turning away, preferring to go for like coal, renewables, whatever. I think, we're going to see it's just a terrible time to be entering service with a new LNG vessel because freight rates are just record lows. We did see freight rates go negative just after the invasion of Ukraine. That was like an extraordinary flash in the pan moment. But I think what we're seeing in the freight rate market now is actually more structural. It will take longer to work through the system because after like the 2022 invasion or the full invasion of Ukraine, then freight rates went negative. But then they went really, really high again because the market just went to these unprecedented highs in terms of like the price that Europe was willing to pay for LNG to get it into Europe. So that kind of negative freight rate moment was very temporary. But we've got another 24 months of massive additions to the LNG vessel market, and I don't really see there being a massively strong bullish driver to kind of drive up the amount of LNG being produced in addition to kind of like the baseline contract. So like the spot market's not going to be particularly strong. I think the growth story in China is underwhelming. India is only willing to buy at a certain price point. And, actually LNG production right now is lower than it's been for the last couple of years. In a tight market, you've got to ask yourself, why is that? Why aren't we producing all guns blazing on the liquefaction plants if demand is so strong and it's such a bullish market? Where's the LNG? Where is it? It's not there. It's not on the vessels. That's why the vessels are so cheap. And I think you're going to see this structural weakness persist for like the next sort of 2 or 3 years. And then even longer, because then you've got like an LNG glut, new supply coming on the market. That's when freight rates might recover. Yeah, you might see freight rates, like kind of inverting with the price of the actual commodity itself. So you'll probably see LNG and gas prices finally acknowledging the kind of bearish reality in sort of 2027, 2028. And you could see like freight rates go really high then, because what's going to happen? You've got too much LNG on the market, on the water. What happens? You either put it into floating storage or, you simply like produce it. You might even see like shut-ins in US LNG plants. But for that to happen, then, you're going to have to see like a big correction in the freight market too.
What factors could contribute to the reduced use of floating storage?
Well, right now it's flat calendar spreads. Calendar spreads are flat as a pancake. You can barely get a dime between December and January. So, why would you hold LNG on the water any longer than you have to? And it's just simply loss making, because LNG is not like gas, not like coal or oil. It boils off. You've got to have certain systems running on the boat. You've got to kind of have it circling around. You can't literally just like anchor up. So there are costs which are borne by floating storage, and the only reason you do that is if the future price of gas is going to cover those costs and your margin, and of course the cost of charter, the cost of freight. So that's another. Sorry, I should have mentioned earlier. That is another factor which is really weighing on freight rates, is because nobody is using the vessels as floating storage. So only when that changes, that tends to be the biggest driver of like bullishness in the freight market, is when the vessels are needed to put the excess LNG into, and we're just not seeing that. So European LNG imports are, I think, at a 2-year low in October. October, the month just gone, like they went to like a 2-year low. Everyone said, "Oh, look, we're like pulling loads of gas out of storage. That's a very bullish driver." It's like, well, yeah, no, we're pulling gas out of storage because it was bought at a premium and prices are still high, so it makes sense to take gas out of storage rather than pulling in more LNG at more of a premium. It's like there's no reason to do that. So demand is soft. And demand for vessels is soft, demand for the commodity is soft.
Given the constraints in the Suez Canal and the Panama Canal, what alternative shipping routes are LNG carriers using?
Cape of Good Hope. That's become it's kind of become baked into the trading decisions of a lot of LNG exporters and traders. We saw like record volumes going via the Cape, both from the US Gulf Coast going to Asia and from Qatar going up to Europe. And you got this bizarre situation where you've got like LNG vessels passing each other around the southernmost tip of Africa. And it's interesting because we've seen the Panama Canal come back into service. There's more availability now. And they're trying to lure LNG vessels to take some of those slots because the Panama Canal is obviously so utterly critical to the well-being of Panama as a nation. So they're trying to lure customers back, having lost them. But traders have realized, wait a minute, if for me, freight cost, if like freight is a sunk cost for me, and I've actually done a lot of successful trades via the Cape of Good Hope, it uses up excess tonnage in the market, and it avoids me having to pay canal fees, then why would I go hurry through the Panama Canal to get a vessel back to reload in the US Gulf when fundamentally commodity demand isn't very strong and I've got all this shipping tonnage that I've already paid for? So the Panama Canal is in a bit of a bind, really. They had this drought, which obviously no fault of their own, but they've kind of, the customers are being forced to look for alternative routes, which they've done. They've found. Turns out it's actually perfectly viable, particularly with freight rates being where they are. And now the canal is kind of, it's facing an uphill struggle to get its customers back.
I want to move on to Asian LNG bottlenecks, another area I know you have written on. How are geopolitical factors influencing the current and future bottlenecks we're seeing in Asia?
So I would read geopolitical factors as meaning price. Geopolitics, when it flares up in the Middle East, when it flares up in Russia, for all the reasons I've talked about today, you see higher prices. And these markets are extremely price sensitive. There are two major bottlenecks to getting LNG into Asia. One is the price, and the other one is the amount of actual import infrastructure that's available to get the gas into those markets, and like downstream infrastructure to distribute the LNG. The price factor is the biggest of the two. People don't talk about the infrastructure so much, but I think it matters. I've conducted analysis in LNG Flux, which I published on EklipX recently, which just shows that there is going to be an infrastructure constraint on LNG demand growth in the big kind of demand saviors for the LNG industry, so like Thailand and Vietnam, countries like that where demand is expected to surge. They need to build more terminals, but not just the terminals. I like to say, LNG demand begins at the terminal. If it's a new gas market, particularly like Vietnam, you've got to then develop the downstream distribution and latent, give life to the latent demand, which is just lying there, which could be met by gas, but if the gas literally physically can't reach them, people, then they're not going to use gas. They're going to use LPG or whatever alternative they're currently using, or just go without. So I think there's if the LNG industry is going to deliver on its big promise of huge growth in Asia, they need to start paying more attention to downstream infrastructure, both at the kind of import regasification terminal, or even as liquid fuels to develop LNG trucking capability like they've done in China. But these are extremely hard businesses to make work, particularly when LNG is too expensive. And again, it goes back to the Europe question, it goes back to the Russia question. The prices are too high. As long as LNG can't compete in end-use applications, whether it's as a liquid fuel against diesel, or whether it's in power generation against renewables and coal, then it simply won't get used. So LNG has to become structurally cheaper, structurally more affordable for that growth story to become a reality in Asia.
How might advancements in LNG tech or alternative energy sources impact the demand outlook for Asian LNG in the coming years, particularly in relation to infra expansion and economic recovery?
So I don't think there's a big step change in LNG costs on the horizon. I don't think there's a lot of kind of needle moving innovation in LNG. Yeah, there are, improvements, efficiency improvements, and they're incremental and they're very welcome. We've seen LNG vessels reduce the amount of boil off rate, reduce their shipping costs. But I don't really see there being an opportunity for technology to deliver massive reductions in the cost base of LNG. So I don't see innovation really delivering there. But I do see massive innovation in battery technology. I see massive innovation or just deployment, scaling up of renewables. And the more that those kind of technologies penetrate more deeply into growth markets, then the more they're going to be eating into that growth story for LNG. And I don't know if the gas industry's really kind of come to terms with that reality yet, because for those countries, what's the most important factor is energy security. And gas is not a domestic resource for most of those countries. For some of them it is. Like you've got countries that are old gas producers, they need to backfill their old gas fields that are running dry. But for new markets, then they run on coal. Coal is domestically available, or they have reliable supplies with a neighbour that's got just excess coal on their books, and everybody's happy. So it's like the coal renewables pairing is going to be really hard to shift across a lot of price sensitive Asian markets. And the idea of tying their economic fortunes and increasing their import dependency on a fuel that's kind of subject to extreme price excursions on the other side of the world relating to geopolitical events in Russia, Ukraine, Europe, Middle East. That's not a very attractive prospect. If you're an emerging economy that wants to industrialize and catch up with China, catch up with India, then banking on LNG to fuel that is a very expensive and kind of unpredictable way of delivering on the economic prosperity for your people. Whereas wind and solar are domestic resources once you've got the equipment, that is. Coal is generally a domestic resource across a lot of Southeast Asia. It's a hard sell for LNG. That it really needs to kind of shake off this kind of much price gouging behavior on European gas hubs to lower the price in spot markets, just kind of structurally to have any chance of competing with those alternative power sources.
Pertinent and relevant points, especially as gas is considered such a transitional fuel now. And I want to talk now about the risks and opportunities associated with increased reliance on spot markets for LNG in Asia, and how might this affect price stability and supply security?
So the spot market is going to become much more important, but it's a slow burn. Most LNG is transacted under long-term contracts that tend to be indexed to the price of Brent, and if you have your hands on one of those contracts, then it's kind of you're in a lucky position, because the price of spot has gone so much above the price of oil-indexed LNG that everybody wants one. Everybody wants a kind of an affordable, long-term, in Asia this is, they want kind of long-term, if they're going to go for LNG, they want it on a price that's affordable, predictable, long-term. They know what their fiscal exposure is going to be for these big state-backed LNG buyers. You're going to see this big uptick in uncontracted LNG on the water. So a lot of long-term contracts that Qatar signed are rolling off over the coming years. There's going to be a lot of uncontracted spot LNG from Qatar, plus, of course, destination flexible US LNG coming onto the market. The spot market's going to become much more prominent. For the reasons I said, I don't know how attractive that will be, because once you buy in on the spot market, you take the market price. It's very difficult to hedge forward in the spot market for LNG in Asia. There isn't really a very widely used physically delivered futures contract for LNG. I know that there are market providers who are trying to fill that gap, but I think until they do, then the spot market's going to be very much a kind of take it or leave it option, and LNG will be there as a kind of top up for those countries that have a bit of LNG import infrastructure available, and they've got a little bit of extra power demand. I will just top it up with a bit of extra LNG, but I can't see the spot market, unless there's structural change in how the spot market works in Asia. I can't see that being the place where a big state-run LNG buyer decides to kind of commit to 20 cargoes a month for the next 20 years. It's just it's a risky bet to take. They'll dip in when it's affordable, and they'll just turn their backs when it's not.
Given the rise of AI and the usage ballooning really amongst physical traders and financial players, certainly with big data models and AI, can AI enable traders decipher market discrepancies more effectively than human traders?
Yes, I'd say they can, but I would caveat that with an observation that it's because AI is influencing both the forecasting of prices and the kind of buy-sell orders that are being executed in the market. So what does that mean? I mean, fundamentally, we're seeing a kind of relegation of human discrepancy and human circumspection from the general trading landscape. So outsourcing of those decisions to AI means that AI is kind of making slightly more black and white decisions on like whether to trade or not. They might be kind of overly attuned to certain parameters than others. But then at the same time, they are kind of influencing outturn because, you know, when you make a trade decision, you're also influencing how people perceive the market. And those people are other AI bots as well, right? So when AI makes a forecast based on what it thinks the price will do, and then the price moves in response to an AI-based forecasted trade, then you're creating a kind of positive feedback loop because other AIs are looking at the price movement and all the fundamentals and all the big data, and it's kind of reinforcing the view that AI's forecast is true. So you have this situation where, you know, it kind of validates the AI assessment of forecasts, which then means that those forecasts are relied upon more because they tend to be right more. So you're going to get to this point where the outsourcing is a necessity because the AIs are better, but that's because they're actually influencing the outcome of the price itself. And I don't know, when you get down that kind of slippery slope, is there any way back for the human mind to actually take a proactive, singular role in decision-making that can outsmart the AI? So that's like a massive unknown question, and it's something that's going to be really interesting to observe over the coming years.
Thanks for that, Seb, and for letting us pick your brains.
My pleasure. Hopefully I'll join you again, Max.
We look forward to inviting you back very soon.